Welcome to the deep dive.
Mm.
Okay, so if you checked the charts recently, you probably saw Bitcoin take a stunning, sharp drop.
Oh, yeah. Hard to miss.
We are talking about a 4-day crash where the price fell pretty dramatically from, what, $115,000 on October 14th?
Right, down to a 4-month low of $104,000. That's an $11,000 move.
Exactly. And for anyone watching their portfolio, I mean, that sounds like the beginning of a disaster, right? Like pure panic selling.
It definitely looks like a disaster on a headline level, yeah. But the beauty of crypto really is we don't have to just guess what caused the volatility. We can look directly at the blockchain data.
Ah!
So our mission today is really to move past just the price noise
Right.
and treat this pretty dramatic correction as a data event.
Right.
We're looking at what the top analysts, specifically the team at Glassnode, say was actually happening under the hood.
Gotcha. So the goal isn't just to report the crash, but to actually analyze its internal mechanics. Was this sharp decline a signal of total market failure, or was it, like some experts are suggesting, maybe a healthy, necessary reset?
That's precisely it. And here's maybe your initial nugget to frame this whole deep dive. The consensus from the data analysts is that this was overwhelmingly a flush of excess speculation.
A flush.
Yeah, not the start of some broader catastrophic market collapse. The market essentially hit the emergency brake on itself.
Okay, an emergency brake. Let's unpack that mechanism then, because the speed of that price movement, $11,000 in less than a week, that was staggering. Took us to the lowest point since June.
Yeah, it was fast.
So what was the immediate, technical response in the market when that pressure really hit?
Well, Glassnode's data immediately flagged the response as a defensive rotation.
Defensive rotation.
Yeah, think about that term. It means as the price started to fall, investors weren't just, running for the exits randomly. They were making a calculated shift. They moved away from chasing gains, that classic speculative behavior we see, and focused much more intensely on protecting capital.
Okay, so that implies caution, maybe risk management, not just blind panic.
Exactly,
Yeah.
which is the opposite of blind panic.
That distinction feels really key. But the term that keeps coming up for the cleanup is flushing out excess leverage. Now, for you listening, if you hear leverage and just think complex finance stuff, how do we visualize that? What did that risk look like before the crash, and why is flushing it out actually a good thing?
Yeah, it sounds counterintuitive, doesn't it?
Yeah.
That a rapid price drop could be good. But sometimes it is. We can use an analogy here.
Okay.
Imagine the market right before the crash, like a pressure cooker that's set way too high.
Right, getting unstable.
Exactly.
Yeah.
You've got the heat, which is maybe the aggressive upward price movement combined with too much steam. That's the over-reliance on borrowed money, leverage. The whole system becomes wildly unstable, and it's threatening a catastrophic, uncontrolled explosion, which, in market terms, means a devastating liquidation cascade that just wipes everything out.
So the crash itself wasn't the explosion. It was trying to prevent one.
Precisely. The crash acted like the quick, decisive pressure release valve.
Ah.
That rapid drop in price forces those who borrowed too much for their big bets to either sell immediately or, well, they get liquidated automatically by the exchanges.
Right, the margin calls.
Yeah. And this process just scrubs that borrowed risk out of the system. It's painful, sure, but it's quick.
Yeah.
And it brings the whole structure back to a safer, more stable equilibrium.
Okay, so the system reset itself. How do we measure if that actually worked? What's the proof that the flush did its job?
Well, the proof is in a specific data point called open interest.
Interest, okay.
Yeah, open interest is basically just a running count of all the futures contracts or derivative bets that haven't been settled yet. It's really the clearest measure of how much leverage, how much borrowed money is sloshing around in the system.
Got it.
And the data confirmed that Bitcoin's open interest fell by an astonishing 30%.
30%. Wow.
Yeah, that kind of massive, abrupt reduction means the system shed an enormous amount of risk. Glassnode actually noted the market is now far less vulnerable to another liquidation cascade.
So it worked. The pressure cooker is back at a safe setting.
It's a success, yeah.
That 30% reduction really speaks volumes about the sheer amount of, speculative froth that just got wiped away.
Definitely.
But, okay, that raises kind of a fascinating contradiction then as we shift focus. If speculation was just flushed out, why does the data also show that speculative capital is, taking a larger overall market share now? Let's talk about this battle of the holders.
Right, that's the nuance that the on-chain data lets us see. We generally look at two main groups of investors: short-term holders, or STHs,
Okay.
and long-term holders, LTHs.
This is veterans.
Exactly. Now, the supply share held by the STHS, the ones we usually associate with speculative capital, that share continues to rise. However, while their share is growing, Glassnode pointed out that their behavior seems to be shifting. They're prioritizing capital preservation over making new directional bets.
So they're holding what they have rather than, like, aggressively buying more or leveraging up again, putting themselves in protection mode.
But that seems to be it right now, yeah. Protection mode.
Okay, so the STHs are accumulating supply, or at least holding on to it. Where's that supply coming from? And who else might be stepping in to buy?
Well, it's coming from the other side of that equation, the long-term holders, the veterans, the ones who've held Bitcoin for years. LTHs are continuing to sell their Bitcoin, and this is creating some persistent sell pressure. But where that supply is going tells us a huge amount about the current market structure.
Okay, where is it going?
The coins are being absorbed mainly by institutional investors.
Institutions. Okay, when you say institutional investors, who exactly are we talking about? We should probably define those acronyms for you listening.
Good point. We're talking mainly about two groups here. First, ETFs, exchange-traded funds. You know, those big financial products that track Bitcoin's price and give traditional investors easy exposure.
Right, the spot ETFs.
Exactly. And second, DATs, which stands for Digital Asset Treasuries. DATs are basically corporate entities or large funds holding Bitcoin directly on their balance sheet. Think MicroStrategy, though there are others.
Gotcha. So ETFs and DATs, these big players are absorbing what the long-term holders are selling.
An incredible amount of it, yes.
Now, institutions stepping in to buy what veteran holders are selling, I mean, that sounds like a transfer of wealth, maybe market maturation. But doesn't that dynamic also kind of act as a market ceiling?
It absolutely can, yeah.
Like if the LTHs are constantly supplying the market with coins, doesn't that inherently limit how high the price can run aggressively?
It does. And that's the crucial point an analyst Chris Beamish made. He argued that Bitcoin's upside movement will likely remain significantly limited until this group, this cohort of long-term holders, stops selling.
Because they're providing constant liquidity, but also constant resistance.
Exactly. Every time the price tries to push up significantly, there's this consistent, measured selling volume from LTHs ready to take some profits, and it prevents that aggressive upward momentum from really sticking.
Okay, that explains the structural resistance pretty clearly. Now let's shift gears a bit to the human side of the market. Segment 3, talking about maybe weak conviction and those external global factors. Jan 3 CEO Samson Moe had some interesting comments on the psychology right now.
Yeah, Moe gave a pretty clear warning about the psychological battle happening. He basically said that this specific price range we're hovering in, he put it between $0.1 million and $0.2 million, so $100K to $200K,
right,
is a hard time for those with weak conviction to HODL Bitcoin. It's a real test of will in this zone.
And what exactly is feeding that uncertainty or testing that conviction right now? What's making it so hard?
It seems to stem from a couple of key areas. First, the historical cycle that many Bitcoin investors expected, that predictable 4-year pattern, it hasn't played out exactly as anticipated this time around. That creates doubt.
Expectations not met.
Right. And second, you've got strong competing rallies happening in traditional assets. Gold, for example, is rallying quite strongly.
Yeah.
That pulls investor attention and maybe capital away from the crypto narrative.
Yeah, that makes sense. Which brings us to that classic crypto term, paper hands. What's the challenge they face? Like, what causes them to sell at times like this, especially if the underlying tech hasn't changed?
Well, the challenge is really handling the volatility without the psychological strength to hold through temporary setbacks.
Okay.
We can use a metaphor here to clarify the kind of weight needed.
Yeah.
Strong conviction, that HO dealing ability through the downswings, it acts like a heavy ship's anchor in a violent storm.
Okay, I like that.
That weight keeps the ship steady, fixed, despite the chaotic waves crashing around it.
Right.
But those with paper hands or weak conviction, they basically lack the weight of that anchor.
So they get tossed around.
Exactly. They're easily shaken out by these temporary correction waves, like the drop we just saw from 115K to 104K. And it causes them to abandon their position at maybe exactly the wrong time, just when the risky leverage has actually been flushed out.
Right. They confuse necessary short-term volatility with some kind of fundamental failure. But it's not just internal psychology causing these waves, is it? External markets seem to be having a really immediate, measurable impact, especially on institutional behavior.
Absolutely. Global macro, political uncertainty, These are acting as major headwinds now.
Yeah.
It really demonstrates how connected this market has become to the wider world.
Yeah.
We saw a really stark example just this Monday. Bitcoin ETFs recorded $40 million worth of net outflows, and that marked their fourth consecutive day of selling.
40 million out in one day, fourth day running.
Okay.
And crucially, the analysts didn't just point to some vague macro fear, did they? What was that selling directly connected to?
No, they were specific. It was explicitly connected to the political turmoil surrounding President Donald Trump's renewed tariff threats against China.
Wow. Okay, so direct line.
Direct and immediate causality. A geopolitical event involving the U.S. and China immediately tests institutional confidence, causing these large, regulated crypto ETFs to sell off. It just shows how sensitive those institutional on-ramps are to political shifts now.
That's fascinating. Yet, despite all these turbulent internal dynamics and these external political headwinds, Samson Moose still sounds extremely bullish, right? Predicting Bitcoin will add a zero soon enough.
He does. Still very bullish long-term.
And we probably shouldn't forget Elon Musk popping up again, kind of providing that philosophical counterargument to being overly reliant on geopolitics.
Exactly. Musk recently used his massive platform to tout Bitcoin again, calling it energy-based, fundamentally inflation-proof, and explicitly contrasting it with what he called fake fiat.
Right.
It just reinforces that core long-term thesis for the holders, even while the day-to-day trading decisions might be driven by anxiety over tariff threats or political cycles.
Okay, so let's try and tie this all together. What does this all mean for you, the person trying to make sense of this market? Let's synthesize these three layers: the mechanical flush, the structural holder battle, and the psychological external pressures.
Okay, the key takeaway seems clear. The recent dramatic crash was primarily a necessary technical cleanup, a healthy flush, actually, of leveraged speculative capital that stabilized the system. So that's the good news, fundamentally.
Right, system is healthier.
However, the market's path to really aggressive upward movement seems currently limited, structurally, by that consistent selling pressure from long-term holders.
Which the institutions are absorbing.
Which institutional buyers are absorbing, yeah.
Yeah.
And finally, that whole price structure is proving extremely sensitive to immediate global political instability. We saw that directly with the ETF outflows tied specifically to U.S. tariff threats.
So it wasn't a failure, but it definitely served as a kind of high-pressure diagnostic test. It highlighted exactly where the current resistance lies, both from inside the LTH group and from outside, from these macro events.
Which brings us maybe to a provocative thought for you to consider as we wrap up this deep dive.
Okay.
Given the measurable, immediate impact of U.S. political turmoil on institutional confidence, those specific ETF outflows we identified, is the influence of global macro and political events now, maybe, permanently outweighing the historical internal influence of the traditional crypto market cycles?
Ooh, that is a massive question. That requires looking way outside the typical crypto box, doesn't it?
It does.
Wow. Okay, well, we covered a huge amount of ground today, really pulling out the most critical signals and connections from the source material, I think.
We certainly did. Thanks for joining us as we explored the internal data behind this pretty dramatic market correction.
Yeah, absolutely. And hey, be sure to follow, like, and share this deep dive if you found it useful. And of course, you can follow What Bitcoin Taught Me on all the major platforms: Twitter, X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn.
Lots of places to find us.
Definitely. Catch you next time.